What's up, everybody? Welcome back to part 2 of this video. I'm Ski Mask Bro, and today we're going to be continuing our Project Christmas LBO case study. If you guys haven't watched the first video, just click the link in the description below where I'm sort of just setting up the transaction assumptions and things like that and walking you guys through the case study. Sorry, my friend's in the background. It's the holidays. My cousin's just sleeping over. But anyways, with that said, we're just going to hop straight into it. And if you guys want to follow along, I've also incorporated the PDF download link as well as the finished Excel below for you guys to follow along while you're watching this video. So in the prior video, what we did was that we set up the transaction assumptions, the entry assumptions, leverage assumptions, sources and uses, and goodwill calculation. And in this video, we're going to do 4 things. The first thing is build out a P&L schedule, build out a balance sheet, build out a cash flow statement, as well as a debt schedule, and ultimately link them together. And then in part 3, I'm going to walk you through how to sort of build the return waterfall and calculate like the different return thresholds. My guy's coughing in the background, but it's fine. Okay, so with that said, we're just going to hop straight into it. So first off, you want to start with your P&L assumptions. Let me just take a look at what these assumptions are in the PDF. Okay, so you're going to start with your various line items. Here to give you the revenue assumption, you have your gross profit, and then it seems here that they give you an S&M assumption, so you're going to plug that in. S&M, G&A, EBITDA, and then less D&A, less amortization of intangibles. And the reason you guys have amortization of intangibles here is because if you guys remember from the last video, we have sort of a goodwill step up, and sort of like that asset step up that you create through the write-up sort of creates like an intangible asset that represents the premium of the acquisition, and that asset sort of gets amortized over time on your balance sheet. So that's why you have that here, and that's sort of grouped into your DNA, but we're just splitting it out here for simplicity purposes, and it's easier for you to link. So the second thing, you're gonna have your EBIT, and now you're gonna sort of less your cash interest expense, less your PIK interest, and less the amortization of your financing fees, and you have your earnings before taxes, and you have lesser taxes, and then you have your net income. So basically, guys, like I said in my last video, sort of like practice and repetition makes perfect. So before you guys step in your interview, you guys should have a couple of repetitions building out these different models from scratch. So you sort of like just memorize the flow. So the moment you go into it, like, and based on the different variables they give you, like, you sort of like just instantaneously water down from revenue to net income. And then let's say like they don't have an asset step up, so you won't have your amort of intangibles here, but then like a majority of these things will be here for your case study. So once you memorize it, you sort of like go in, it becomes muscle memory, you just plug it down. So now you have your assumptions, you have your percentage revenue growth, percentage gross margin, percentage S&M, that's one of the assumptions given in PDF. And you have your G&A, which is going to be a flat number. And you have your percentage D&A as a percentage of revenue. And then you have your CapEx as a percentage of revenue. So this is where we're going to put our hard-coded assumptions. And with that said, we're just going to go ahead. So let's see. The first assumption that you get is your revenue assumption. So that's a 110. Let me just bold this up here for now. And then accompanying that, you have your revenue growth assumptions per year. So revenue grows at 6% per year. I'm just going to come up here to our number formatter. Make this blue for hard code. And we're just going to drag this across because it's consistently growing at 6% per year. And then for your gross margins, you have 40%. Stays flat through the projection period. Same with your S&M. And then your D&A and CapEx are both at 1%. So I'm going to do that. And then your G&A is actually going to be 15 flat per year. So now your assumption is set up, and you're just sort of going to link this to your P&L. So revenue grows 6% per year. And then your gross profit is going to be your gross margin times your revenue. So you have that less your S&M, which is 8% of revenue. Make that negative, so you can just sum everything up easily. and then your G&A is 15. Oops, let's make it negative again. So now your EBITDA is basically going to be 20. And now basically for the transaction year, which is your last historical LTM year that you base your multiples off of, you're not going to water down in net income. It's the years ahead of that. So the moment we get our EBITDA, what we can do is we stop here, we come up here, and we sort of just plug that number in and flow it through the rest of the model that we have. So equals that. So now you have an enterprise value of 222. That's going to be the entry value for your transaction. And as you guys can see, like before we left it blank because we didn't have the EBITDA figure yet, but the moment you get it down here, you plug it back up here, it flows through the rest of your model. So is there anything else we should do? Nope. So we're just going to continue going forward now, except for the projected years. D&A as a percentage of revenue is 1%. Amortization of intangibles, you have that up here. It's going to be negative 2.2 for now. But then once we get the balance sheet figures, we're going to plug it in here. So that's going to change that number. But for now, we'll just have it for now. Your EBIT is going to go up to that figure. Your cash interest expense and your PIK interest is going to come via your debt schedule that we're going to build. So we're going to highlight that for now as well, because we're not touching that. And then the amortization of your financing fees is going to come from up here that we have. So let's see, it's 0.2 per year. Anchor that, because it's a 10-year straight line amortization downwards. Gonna sum everything up. And then for your taxes, you're just going to do your earnings before taxes times tax rate that was provided to you in your assumptions. You're going to anchor that tax rate. Again, make it negative and paste it across. So that's basically the P&L. And then the next thing you want to build out is you want to build out your balance sheet. Come down here, balance sheet assumptions. And the thing with the balance sheet transactions, the thing with the balance sheet during an LBO transaction is that you want to adjust it, right? Because you have your pre-transaction balance sheet, which is basically the company on a standalone basis, and then you have the sponsor coming in and buying it. So it's injecting sort of like fresh equity into the company and taking out whatever existing debt and existing equity holders. And then also it's sort of hollowing out the cash and then putting cash onto the balance sheet. And that's where your min cash balance comes from. So you sort of, on columns M all the way to P, what you want to do is you want to highlight the 4 of these, change the column to 12. And then you want to just make your adjustments right here before we begin filling in the balance sheet. So you're going to have your pre-transaction, your debit, and your credit accounts. And then you're going to have your post-transaction balance sheet. So with that said, we're just going to go ahead and sort of fill everything out. So you're going to have your cash. Let's see what's provided in the PDF. Cash, your accounts receivable, inventory, prepaid expenses, PP&E, oops, your goodwill. And then remember, for a balance sheet, they're going to give you the certain static items, but then other items are also created. They're implicitly created based on the other assumptions that they give you, right? For example, like the asset write-up, which creates like the amortization of your intangibles, which means that it also creates an intangible asset that sits on your balance sheet. So you're going to have to insert that in yourself. So intangible assets. And the way you remember this is that, like, basically once you do this enough, you have like sort of triggers in your brain. So like the moment you see like a write-up, you know, okay, like I need to amortize intangibles, and intangibles automatically become on the balance sheet. So it's like it becomes muscle memory. Like the moment you see that sort of variable on there, like you automatically just put this in here when you're sort of creating stuff. And then you also have your capitalized financing fees from your financing fees that you incur as a process, like in your process of raising debt. And then now we're going to do our liabilities. So you're going to have your accounts payable, your accrued liabilities, your DTLs, your term loan, and these are like sort of like the new things that are going to end up sitting on your balance sheet that's not there prior to the transaction. PIK debt, and then you have your total liabilities, and then you have your shareholders' equity. And you have your total liabilities and shareholders' equity. And then here what you want to do is you sort of want to build out a check, right? Because your total assets should equal your total liabilities. So when they subtract each other, it should zero out. And you're going to add that check on your pre-transaction as well as your post-transaction balance sheet. So let's see what variables are given to you. So on your pre-transaction balance sheet, you have no cash because it's on a cash-free, debt-free basis. You have accounts payable of 10, inventory of 20, prepaid of 2, PP&E of 10, goodwill of 50. And then you have no intangibles and no capitalized financing fees as results. And for your liabilities, you just have two things here. And then you have 85 for your shareholders' equity. So what we're going to do is we're just going to copy this format here. So just going to paste. I'm going to sum everything up. Oh, oops. As you guys can see, like the variables that are provided to you now sort of zero out. So your check checks. Let's line this to the right. So now basically for your post-transaction, what you're going to do is you're just going to do a sum. And just bring everything down. F4 to repeat your previous action. Drag the formulas here. Oops. And then just drag the formulas here all the way to 21. Looks good. And now we're going to sort of adjust the balance sheet using various debits and credits. So on the asset side, a debit is going to increase your asset amount, a credit's going to decrease it. On your liability side, it's the inverse. So a debit, when you debit a liability account, it decreases it, and when you credit it, it increases it. So let's see, we're going to start with our cash. We have our min cash balance, right, of 2. So we're going to come here, link it to our uses. So it's going to be 2. Accounts receivable, there's no change, no change, no change. PP&E, no change. And our goodwill actually changes. So you have your pro forma goodwill figure right here, which is going to be your 194. And then you're going to credit the existing goodwill. So you're going to wipe that out, and then you're going to replace it with your pro forma. And then before we go any further, I noticed that now we have our balance sheet figures sort of put in here. So what you're going to do is you're going to fill out these remaining variables for the goodwill calculation to get your true sort of pro forma goodwill figure. So you're going to less the book value of your equity, which is ultimately a shareholder's equity. And then you're going to add your existing goodwill, which is essentially 50. So at the end, what you get is you get 163. Oh, you're gonna add your details. So the detail is gonna be positive. Okay. And now your goodwill is gonna be 173. And then for your intangible assets, you're going to have, let's see, what's the figure for intangibles? You're going to add in your write-up, so you're going to debit that up. Negative that. And then you have your capitalized financing fees, which you're going to come here and you're going to take the entirety of the total financing fees from your debt facilities and plug it in here. For your accounts payable, no change. On the liability side, for your liabilities, no change. DTL, yes. I'm going to credit that because that's going to be an increase. So DTL is going to be 4.7. Your term loan, I'm going to take that from your facility amount. It's going to be right here. Senior note, PIK debt. And then your shareholders' equity. you're basically going to debit out your shareholders' equity, annihilate sort of like everything there, and then you're going to add back your transaction fees. Sorry, you're going to net out your transaction fees. So you get 90. And then you're going to credit that account, and you're going to increase it by the amount that the sponsors are injecting in. So essentially, it's going to be the sum of your sponsor equity as well as your management rollover, because those are going to be the new equity holders in the business. So now once that's plugged in, you see the balance sheet ties, so you can proceed with the next step. This is basically your working capital assumptions. But first, we're going to come to 2021. This view of the balance sheet in 21 is going to be assuming post-close at the end of the year. So you're basically going to link everything to the post-transaction column, which is column P. Now everything ties, and we can proceed forward. Basically, we're going to highlight all of the sections that we can't fill out for now. We need the cash flow statement to do, which is basically going to be everything outside of your current liabilities and current assets. So these, we just need a while to fill them out later, but then you can sort of like proceed right now with your current assets and your current liabilities. So you have your DSO and your DPO assumptions. Oops. Scroll down for more space. We're going to link it up here basically. That's receivable. All the way down to your prepaid expenses. And you're going to link this to your current liabilities. Not your details. Hard code. Alt ESV. And now we're just going to sort of calculate our days outstanding. Our working capital change assumptions. So you're going to come here to the accounts receivable figure. And basically, the formula for accounts receivable is going to be your AR divided by your revenue times 365. So basically you get 32 days outstanding. And then in the PDF, what it says is that it says to assume that your DSO and DPO assumptions stay flat over time. So it's going to flatline it going forward. Your inventory is going to be very similar, except it's going to be a percentage of COGS, right? So it's going to be your inventory amount divided by your COGS. And here you just have your gross profit and your revenue. So it's just going to be your revenue minus your gross profit. It's going to get you COGS. And divide by that times 365. We're going to flatline that going forward as well. Your prepaid expenses, usually it's not going to be on like a turnover assumption. So it's going to be a percentage of revenue. So that's how we're going to run it. So your prepaid expenses is going to be 2 divided by your revenue. And let me just take the percentage number format here, post it down, flatline going forward. Now your accounts payable, same thing. 5 divided by your COGS, so your revenue minus your gross profit, times 365. Flatline that going forward as well. Accrued liabilities, that's generally a percentage of revenue as well. So you're just going to take your 2 and divide it by the revenue amount. Copy the number format here. Basically the same thing. Okay. Now what we're going to do is we're going to forecast and push forward what our accounts receivables and what our current assets and our current liabilities are based on our P&L. So what you're going to do is you're going to want to inverse this equation. So you're going to take this, for accounts receivable, you're going to take this 33.2 turnover ratio times 365 divided by your revenue amount. Oh no, I messed it up. You're going to take the ratio divided by 365 times your revenue amount. So that's what it's going to look like going forward. And you're going to inverse it for each one of these. So for inventory, remember it's on COGS. So you're going to divide it by 365 times your COGS. So your revenue minus your gross margin. good. Prepaid expenses. Sys times your revenue. And I'm just going to drag this formula down real quick for accrued liabilities. Okay. Accounts payable, same thing. Take this 27.7 figure times 365. Oh, sorry, divided by 365 times your COGS, so your revenue minus your gross margin again. Gotta push that forward. Okay, so basically right now we've successfully forecasted and pushed forward your current liabilities and current asset assumptions. So we have these other things that we need to fill in. In order for us to fill it, we're going to need to build out a cash flow statement. So that's exactly what we're going to do next. Copy that down here, delete these, and just rename this cash flow forecast. And now this is the order that you're going to type things in. You're going to start off with your net income, so your cash flow from operations. You're going to add your depreciation and amortization, add the amortization of intangibles, basically everything that you have on your P&L that's non-cash, you're going to add back. So add your amort of financing fees. You're going to add your non-cash PIK interest. Because PIK interest, like that interest is basically accrued onto your debt. It's a non-cash interest expense that's recognized on your P&L because theoretically it's interest that you deduct, but then it's non-cash, so you add it back in your cash flow statement. Got that, and then you're going to less the unwind of your DTL. And then you have your net working capital changes. So change your net working capital. My bad, my recording stopped because I ran out of computer space, storage space, so I need to clean things out. But where did we leave off? We left off at the change in net working capital. So, sorry, let me just unbold this and underline. Okay. So now you have your accounts receivable. I can't spell receivable for the life of me. I'm not even sure if that's correct, but it's whatever. Prepaid expenses, accounts payable, and your accrued. You know, why am I not just linking up here? Hard code. And now you have your cash flow from operations. So that's going to be one line. And now you have your cash flow from investing. And here you just have one assumption that they gave you, which is your CapEx. And then after that, you have your cash flow from financing, which is going to be primarily just your debt pay down. So you have your revolver, your term loan, and then your senior note. You're not going to have your PIK because you're not really paying that down. That accrues over time. So that's why you just have these three schedules here. No, these three debt facilities here. Sorry, it's a little late in the night, but I have to do it. I actually had a pretty busy day at work today, which is surprising, given that it's the Friday before New Year's. So now you have your net change in cash. So here, we're going to start linking up our cash flow statements. Your net income, you're going to link it up here. Oops. Oh, oops. Your DNA, link that to your P&L as well. You're going to do a negative sign to inverse all the negatives. This is a non-cash expense. You're adding it back. adding it back. Amortization of intangibles, same thing. Just making sure everything's linked. Your amortization of your financing fees, same thing. You have right here your non-cash PIK interest. We don't have this yet. Oh, we can still link it. So you're gonna link it here. Negative. And then the unwind of your DTL, which isn't on your P&L, but it slowly sort of like unwinds off. So you're gonna go to your goodwill calculations that we did before, and this line right here. You're going to less that because that's a tax. That's a cash expense. And the reason for that is because when you write up an asset, theoretically there is tax liability that's associated with that asset. So basically, like, you write it up, you owe a certain amount of taxes, but you don't need to pay that tax immediately. You can sort of pay it over time. So it's technically a source of cash because it's an expense that you owe, but you're not paying it yet. You're deducting it from your sort of like P&L. No, sorry, it's an expense that you owe. You're not really paying it yet, so you still have the cash. But then over time, as you're paying it off, it's a use of cash, so that's cash flowing out of the business. So deduct that, and once we have these four things, we're just going to roll it forward. Sorry, let's anchor or unwind. And now for accounts receivable, remember for assets, it's a use of cash. So you're going to do the prior year minus the previous year. So any increases would be negative, any decreases would be positive. Oh, oops. Almost messed up here. Accounts receivable. And then for your liabilities, it's a source of cash. So it's your current year minus your previous year. So any increases would be cash flowing in. Any decreases would be cash flowing out. So now for your cash flow for operations, you're just going to sum everything up. And then for your CapEx, you have your assumption up here, 1%. So you're going to multiply that by your revenue. Make that a negative because it's a cash outflow. And then there's your cash flow from investing. And then the debt pay down, we're going to fill this out once we make the debt schedule. But let's just put in a sum here real quick. So now your net change in cash is basically going to give you your cash flow from operations plus your cash flow from investing plus your cash flow from financing. Good. And now, guys, with that said, we're going to go on to build the last thing for this video, which is the debt schedule. I'm going to copy this. Come all the way down here. Debt schedule. And basically, guys, what I want to do is you have two options when you build a debt schedule, right? You can, one, just build it straight up with your like beginning balance, repayments, ending balance, etc. And then you can build everything out. But then, like, what I want to do is I like to keep everything organized as a sort of a check, right? So right now, what we're going to do here is we're just going to build a quick schedule right here. And this is basically going to be called the cash flow waterfall. You're going to start off basically by waterfalling down your free cash flow that's available to pay every tier and each tier of your debt. So you're going to have your free cash flow available, so service, debt in general. You're going to less your mandatory repayments, your mandatory amortization of principal repayments on your term loan. And then after that, you're going to have sort of your free cash flow available to service your revolver, right? Given that revolver is short-term debt, it's more immediate. You need to pay that within a year. So you're going to use whatever cash to pay that tranche first. But then also because your term loan has sort of like a mandatory amortization amount for it, that precedes the repayment of the revolver in the order in which you pay off the debt. So you're going to sort of deduct out the cash used for your mandatory amortization for the term loan, and then you're going to use the remaining cash to pay off the revolver, and then et cetera, et cetera. So now, after this is your cash, you're going to less your revolver payment or repayment, and then you're going to have your free cash flow available to service term loan. Oops. Super late right now. I'm actually very tired, but it's okay. Optional prepayment for term loan. And now you're left with your free cash flow available to service your senior note. And then you're going to have your optional prepayment for your senior note as well. And now after this, you're basically going to have your free cash flow post debt pay down / your net change in cash, which should theoretically zero out because we've built in like a cash sweep here. So after you have this, now what you're going to do is you're going to go in and build out your debt schedule. So you're going to have your cash flow available to service revolver. And before we go any further, we're just going to fill it up here first. So you're going to have your free cash flow available to service debt in general. So it's basically going to be your cash flow from operations less your cash flow from investing. Since it's negative, you're going to add it up. So right now you have this much cash available. And then every sort of tranche is going to be a sum. Sum, and then sum. Put that border back there. And then we're going to fill everything step by step as we go. So first off, you have your cash flow available to service your revolver. You're going to link it up here. And then you have your beginning revolver balance less your repayment / drawdown. And then you have your ending revolver balance. And you have your interest rate. And then your interest expense. And then for a revolver, you also have your max capacity, right? Like the way you think of a revolver is just like a short-term credit facility. But the easiest way to think about it is just a credit card for your company, right? Like your credit card gets your company gets a credit card, and then you just like swipe it whenever. You have sort of like a max credit limit on that you can use per year. And then the more you draw on it, the less that you can use. So we're basically gonna be building out that dynamic right here. Available capacity. And then you see here the max capacity in the PDF basically says it's basically going to be a 1x your EBITDA. Let's hard code this real quick. So basically what it's going to be is 1 times your EBITDA amount. It's going to be right here. And then that thing just sort of goes out for the rest of this forecast period. And your available capacity is going to be your max capacity minus your beginning balance for every every year. So you have this, and now your beginning revolver balance. Your ending revolver balance is basically going to be pulling from your balance sheet. So currently you have nothing, right? Because you start with nothing. Beginning balance equal to your ending balance. So right now we're just hard coding to 0 here. Let's make that blue. And then you're going to sum up. And now for the formula for your debt schedule for your revolver is going to be your min of your available capacity, comma, the negative min. It's going to be a nested if formula between that. So it's going to be the minimum of your available capacity compared to the lesser of your cash flow available to service your revolver in your beginning revolver balance. And after you have that, we're going to link sort of like this interest rate up there. So basically, I think the interest rate for the revolver is 4%, right? Yeah, let's take this figure up here. Hard code that. And then your interest expense is going to be your interest rate times the average of your beginning and your ending balance, assuming sort of like a mid-year cash conversion cycle. Yep. So that said, highlight this, and we're going to move on to the next tranche. It's going to be your cash available to service term loan. So you're going to have your beginning term loan balance. And guys, remember, here you also have your mandatory amortization that you need to pay off. So you have your mandatory amortization, and then less your optional repayment, prepayment, and then you have your ending term loan balance. Your interest rate essentially is going to be linked to this 6% right here. Take away the blue because it's not a hard code. You know, since everything's copied over this formula stays consistent. Beginning term loan balance is correct. Ending sum is correct. We need to redo this amount, but basically for mandatory amortization, you're also going to link this figure up here to the 1% principal amort. Take this percentage figure right here. 1%. So it's going to be 1% the beginning balance of every quarter, every year. Anchor that 1%, make it negative. Bring that. Okay, and your term loan beginning balance is going to be whatever you see on this balance sheet, so 60.6. Just get rid of that blue hard code. So every year you're essentially just paying down $600K worth of revolver. And then before we keep going, you're going to come back up here to the schedule. So you're going to link this. You're going to less your mandatory amortization. And then you're also going to less your revolver repayment. It's going to be linked here. Now your optional repayments is going to be the minimum. Sorry, the negative min of your beginning balance and your cash flow available to service your term loan. Now we're going to relink this cash flow available to service term loan, which is going to be here. Oh wait, I made a mistake. So for your optional repayment, you actually need to take into consideration the amortization, because this cash flow available is already linking up here, which is already stripping out the mandatory amortization. So you want to strip it out here again. So it's going to be your min G50 plus, to this compared to that. Yeah, so that is more correct. And now after you have that created, we're going to delete the max capacity and stuff like that because we don't need that. You're going to create your next tranche of debt, which is going to be your senior note. So just be careful with the linking. You know, relink everything up here. So link this to your cash. Wait. So you have your optional prepayment for your term loan. Don't link that down here. And now you're going to link the cash flow available to service your senior note to this free cash flow waterfall right here. And now you're beginning senior note balance. Let's change the title here. Delete out your mandatory amort because that's not needed. It's just one under, so it's going to be 6. Yes. So you're going to have your senior note here. Plug that in. You're running that, and then basically the optional prepayment is going to be the same thing. So it's going to be the minimum of your beginning balance versus your cash flow available to service that balance. Service your senior debt. So as you guys can see, like this is going to change once we link up the cash flow statement into the P&L and back into the balance sheet. But what you guys can see here is that basically the trend is that you have enough cash. The business is generating enough cash for you to pay off the entirety of your term loan through your hold period. But then you're not going to have enough cash to sort of like service a senior note until sort of like year 4, which is like 2025 and 2026. So yeah. And let's just make sure everything here is correct. Oh no, your interest rate is actually incorrect. It's going to be 22. So now it's good. Now after you do that, the next tranche of debt that you're going to have to create is going to be your PIK. So you're not going to have any cash flow available to service your PIK debt because your cash isn't going to go to servicing that. Your PIK is just an accruing debt instrument that sort of gets bigger and bigger as time goes on because the interest adds on to the cash on a cumulative basis and is paid at the end through a bullet payment structure. So you have your beginning PIK balance. You're going to add your PIK interest. You have your ending PIK balance. So what you're going to see here, so this interest rate is actually going to be 23. And it's going to be, it's F2 in here, copy here, make it 7. And you're going to delete out this sort of like interest piece right here because you don't need that. So now as you guys can see, your PIK is getting bigger and bigger over time, and you're going to pay that off at the end when you're calculating your returns, which we're going to do in part 3. But yeah, so basically this is going to be our debt schedule, and once we create that, we're going to come down here, and we're going to do our interest expense calculations. So you're going to have interest from revolver, interest from term loan, interest from senior note. You're going to have your cash interest expense, and you're going to have your non-cash PIK interest. And you're going to have your total interest expense, excluding the fin fee amortization. And sometimes fin fee amortization is treated as an interest expense because technically that's a fee that's associated with with your debt financing instruments that's being amortized over time. So sometimes it could be grouped into your interest expense, but for simplicity purposes, we're going to sort of, or showcasing purposes, we're just going to strip it out. Double board it out here. And basically what you're going to do is you're going to link everything up. So you're going to link your revolver up to your revolver interest expense, which is going to be 0 because you never draw on it because your company has ample cash. You're going to link your term loan up here, and then you're going to link your senior note. Damn, I'm so sleepy. Correct. Okay. Now your cash interest expense is going to be this. Your non-cash PIK interest, you're going to link it here. And then your total interest expense is essentially just going to be this. Just let me check the PDF real quick. Okay. So it seems like everything is flowing through properly right now. So basically the remaining thing we have to do is we're going to link together the cash flow statement, the P&L, and the balance sheet. So we're going to start off with the P&L. Here, now you have your cash interest expense, right? Which is down here. You're going to link that here. You're going to make it negative. And you have your PIK interest, which is also going to be negative. And I'll link that to your PIK interest right here. And now you're going to link together your balance sheet. We're going to unhighlight these. Link together your balance sheet. So your cash is going to be equal to your prior period plus your net change in cash. From your cash flow statement. Oh, wait, before we link the balance sheet, let's actually fill out the cash flow statement first, since these are the low-hanging fruits. So we're going to link our revolver to the prepayment. So we're going to have this. You're going to link your term loan. It's going to be the sum of your amortization, principal, mandatory amort, as well as your optional prepayment. And then your senior note is also going to be linked to your optional prepayment. So that said, as you guys can see, a good check, especially for a lot of these models, is that you're assuming a cash sweep at the end of the day, because all your available free cash flow is used to pay down debt. and then you're not going to dip below your minimum cash balance. So if this zeroes out, you're in a pretty good spot. So now we're going to move on to sort of tying out our balance sheet. So like I said before, your cash is just going to be your cash from prior period plus your net change in cash in this period. That's tied up. It's good. Your PP&E is just going to be your PP&E. You're going to add your CapEx from your cash flow. In this case, it's negative, so you're going to subtract it out because negative minus negative is a positive. No, negative and negative. When you subtract the negative, you're adding it back, and then you're going to add your depreciation. Subtract your depreciation because it's a positive number. And your PP&E actually stays the same because, as you guys can see here, your DNA is 1% and your CapEx is 1%, so it cancels out, so there's no change in PP&E over time. And your goodwill actually stays consistent. Nothing changes here. And your intangibles, you're going to come here, take your prior year intangible assets, and then you're sort of going to subtract out the amortization of intangibles here. Same with your capital as financing fees. You're going to subtract out the amortization of your financing fees, so it should decrease over time. And now the next step is your DTLs. So you're going to take your DTL and you're going to subtract out the unwind. I mean, you're going to add back the unwind because it's negative. So that should also decrease over time. Your term loan, you can just link it to the ending balance of each of your debt facilities. Right now it's 50. Your senior note doesn't get paid down to year 5. Your PIK debt, so you're going to be PIK balance over time. And now your shareholders' equity is going to be this plus your net income amount. Hopefully it ties. Okay. Please tie, please tie. Yep. So there you guys have it. We've built out the cash flow statement, the balance sheet, the debt schedule, and also your P&L forecast, and we've tied everything together. We're going to go ahead and we're going to unhighlight this. And with that said, guys, thank you again for watching. If you guys haven't watched part 1 yet, please click the below. And if you guys want to watch part 3, also click the below to watch the next video. But with that said, thanks a lot for watching again, guys. I'm going to be posting part 3 for the next video, so stay tuned for more. Good night.